Most people think a bank is like a giant high-tech vault. You put your money in, they lock it in a vault, and it sits there safely until you need it. But what if I told you that the moment you walk out those revolving doors, your money is basically gone? In fact, for every $1,000 you deposit, the bank might only keep $100. Or in some modern banks, even less. Where does the rest go? And how does this disappearing act actually create the very wealth that runs our entire global economy? Today, we're pulling back the curtain on fractional reserve banking, the legal magic trick that banks use to multiply money, and why the whole system relies on one thing: that every customer will not withdraw their money at the same time. To understand this, we have to go back to 17th century London. Back then, people didn't use paper cash. They used gold. But gold is heavy and dangerous to carry. So people left their gold with goldsmiths for safekeeping. The goldsmith would give them a paper receipt. Eventually, people realized it was easier to just trade the receipts for goods instead of hauling the gold around. The goldsmiths noticed something sneaky. People almost never came back to withdraw their physical gold all at once. They realized they were sitting on a mountain of idle gold. So they started doing something bold. They began printing extra receipts and lending them out to other people for interest. Those people thought they had gold. The original depositors also thought they had gold. But in reality, there was more paper than metal. This hack was the birth of modern banking. Fast forward to today. This is Sam. Sam deposits $1,000 into Bank A. Bank A doesn't just sit on that cash. They follow a rule called the reserve requirement, or in some countries, the cash reserve ratio. Let's say it's 10%. Then Bank A puts $100 in their stash and immediately lends out the other $900 to Maya to buy a new laptop. Now, look at the economy. Sam's bank app says he has $1,000, and Maya has $900 in her hand. Suddenly, there is $1,900 circulating, even though only $1,000 ever existed. But wait, it gets wilder. Maya pays for the laptop to the store. The store owner deposits that $900 into Bank B. Bank B keeps 10% of it, which is $90, and lends out $810 to someone else for a car repair. And the cycle continues. This is the money multiplier effect. Mathematically, with a 10% reserve, your original $1,000 can turn into almost $10,000 of digital money. Banks aren't just storing wealth, they are literally creating it through debt. You might be thinking, this sounds like a giant scam. But without this system, the modern world wouldn't exist. If banks had to keep 100% of your money in a vault, they couldn't give out loans. No loans means no mortgages for homes, no credit for startups, no student loans, and the economy wouldn't grow. Fractional reserve banking is the engine of growth. It takes your idle savings and turns it into someone else's opportunity. It's a system built on velocity. As long as money keeps moving and loans are repaid, the economy expands and we all get wealthier. It's like turning one pizza into 10, as long as everyone doesn't want to eat at the exact same time. But wait, there's a catch. The entire system is built on one fragile thing: trust. If everyone watching this video went to their bank right now and demanded their full balance in physical cash, the bank would collapse. They would run out of money. In the past, if people lost trust in a bank, they had to physically get in their car, drive to the building, and stand in a long line to get their cash. That took time. It gave the bank a chance to talk people down or find extra money. But today, the banking system has moved to our smartphones. In early 2023, we saw this happen in real time with Silicon Valley Bank. It started with a few viral posts on X and in WhatsApp groups of founders. It wasn't just rumors. Major investors were literally tweeting in all caps for people to get out now. And private WhatsApp groups of founders turned into digital stampedes. Panic spread like wildfire. Because everyone has a banking app in their pocket, they didn't wait for the morning. They hit transfer immediately. In just 24 hours, customers tried to withdraw $42 billion. No bank on earth, no matter how big, keeps that much cash sitting in a drawer. This is why central banks exist. They act as the lender of last resort, essentially pumping emergency oxygen into a bank when it's suffocating. But even they have a breaking point. If the panic is too fast, or if people lose faith in the currency itself, even a central bank can't print trust. So, next time you check your balance, remember, those digits aren't money in the traditional sense. They are a promise that keeps the system moving. Does knowing this make you feel more confident in the system or less? Let me know in the comments. And if you want to keep your financial IQ higher than the inflation rates, hit that subscribe button. I'll see you in the next one.